Hello again everyone, it's me. We're back at EconSphere, where America's economy comes into focus. And today, we're diving deep into a topic that's been dominating financial headlines. The Fed's approach to interest rate cuts. It's a subject that can seem quite technical, but its impact is anything but. Every reduction in interest rates ripples through nearly every corner of the US economy, influencing everything from the housing market to the stock prices on Wall Street to the rates you pay on your credit card. So let's unpack this. First off, what's the latest? The anticipation of rate cuts has been so significant that the stock market, especially tech-heavy indices like the Nasdaq, have seen considerable jumps in value. This is because lower interest rates generally boost corporate profits, making investments more attractive. However, the trajectory of these cuts is not always smooth. After an initial reduction, there's often a pause as the Fed assesses the impact on the economy. This was highlighted in July when, despite market expectations of a more aggressive rate reduction cycle, the Fed opted for a single cut, signaling a potential pause. Now you might be wondering, what does all this mean for different sectors of the economy? Let's start with the housing market. When the Fed lowers interest rates, it makes borrowing cheaper, leading to lower mortgage rates. This can open up home ownership to more people. Potential buyers who previously couldn't qualify due to stricter lending criteria brought about by higher interest rates suddenly find themselves in a better position. Take, for example, a prospective home buyer who was priced out of the market at 6% mortgage rates but could now afford a home at 4% rates. This increased affordability boosts demand, potentially leading to bidding wars and higher home prices. On the flip side, current homeowners might choose to refinance their mortgages to secure more favorable terms and lower monthly payments. Both of these scenarios can infuse money into the housing market, benefiting both buyers and sellers. However, this doesn't come without risks. One concern is that a surge in refinancing could lead to loose lending standards, reminiscent of the subprime mortgage crisis of 2008. This risk is heightened if the demand is driven solely by low interest rates without a genuine increase in household income or financial stability. Additionally, if economic uncertainty persists, it could dampen housing demand despite lower rates, as seen during the pandemic when fear of job loss outweighed the benefits of cheap mortgages. And if that happens, home sales and construction could suffer. Moreover, rising interest rates can impact the value of mortgage-backed securities held by investors like Fannie Mae and Freddie Mac. Lower rates incentivize borrowers to refinance away from these investors, reducing their returns and potentially affecting the financial health of these entities, which could further destabilize the housing market. Next, let's look at the banking sector. On one hand, lower interest rates can squeeze banks' profit margins because they earn less interest on loans. A bank that lends out money at a rate of 3% when its own borrowing rate is 2% nets a 1% profit margin. But if both rates drop to 2% and 1% respectively, the margin shrinks to 1%. This reduced profitability can affect banks' willingness to lend and overall economic growth. On the other hand, lower interest rates can stimulate demand for credit as more individuals and businesses seek to borrow and spend. This can lead to an increase in lending activities and a rise in fees from financial services. In this scenario, banks might actually see an uptick in revenue despite lower margins. However, the net effect depends on how these opposing forces balance out. If lending increases significantly, banks may weather the margin squeeze. But if lending remains flat or drops due to economic uncertainty, then the sector could face challenges. But what about Wall Street? As interest rates fall, borrowing costs decline, making it cheaper for corporations to take out loans and invest in growth. This can fuel innovation, expand markets, and drive higher profits, all of which make stocks more attractive to investors. Tech and growth companies often see the biggest gains because their future earnings get discounted at lower rates, boosting valuations. For instance, a company projected to earn $100 per share next year would be valued at a higher multiple at 2% rates compared to 4%, translating to a significant increase in its stock price. But it's not just about lower borrowing costs. Rate cuts also tend to come when the economy is slowing. The Fed uses lower rates as a stimulus, hoping to boost growth and employment. If successful, this can create a ripple effect across industries, driving better corporate earnings and lifting stock values. Additionally, lower rates can free up investors' cash by lowering the return they need on their investments. At 4% rates, an investor might require a 10% return on their portfolio. But with 2% rates, a 7% return might suffice, leaving them with more capital to invest in stocks, thereby pushing prices higher. However, this rosy picture comes with some caveats. Lower rates can hurt sectors sensitive to changes in interest rates like banks and insurance companies. And if the rate cuts don't address the root causes of an economic slowdown, such as waning consumer confidence or global events, the stock market could still suffer. Now let's shift our attention to manufacturing and industry. Lower interest rates can revitalize these sectors by making credit more affordable for businesses looking to expand operations or invest in new projects. For example, a manufacturer considering investing in new equipment to boost production might find the lower cost of financing through loans or bonds more appealing. This can lead to increased investment in machinery, automation, and research and development, ultimately boosting productivity and output. Additionally, consumers might feel wealthier due to lower interest rates on their mortgages or credit cards, leading to higher disposable income and more spending power. This surge in consumer demand can benefit manufacturers and retailers alike, creating a virtuous cycle of growth. Furthermore, lower rates can attract foreign investment into the US economy, seeing as the country still boasts one of the highest credit ratings globally. This influx of capital can directly fund industrial projects or indirectly bolster the value of stocks and bonds, providing businesses with more resources for expansion. That being said, excessive reliance on cheap credit for investment or consumption is not sustainable and can lead to overcapacity and a subsequent crash in the event of a rapid rate hike cycle. Moreover, if the rate cuts are a response to a weakening economy, it might signal a broader trend of slowing global demand, affecting raw material prices and export markets vital for many industrial sectors. Finally, let's talk about consumer goods. Lower interest rates can benefit this sector in a few ways. Firstly, cheaper financing encourages consumer spending, whether through credit cards, installment plans, or home equity loans. People might use this extra purchasing power to buy discretionary items like furniture, electronics, or clothing, boosting sales for retailers and manufacturers. Secondly, lower rates can fuel the housing market, which in turn drives demand for home furnishings and appliances. Imagine a scenario where lower mortgage rates lead to a surge in home sales. Suddenly, companies producing refrigerators, sofas, or kitchen cabinets see a jump in orders as new homeowners furnish their places. Thirdly, lower rates can spark the stock market, increasing household wealth, particularly for those holding stocks. This can lead to more disposable income and, consequently, more spending on consumer goods. However, this isn't a risk-free scenario. If the rate cuts are a reaction to an economic downturn, it might mean that consumers are already under financial strain. In such cases, even with lower rates, consumers might tighten their belts, prioritizing essentials and cutting back on discretionary purchases. In conclusion, the Fed's decision to cut rates has wide-reaching implications that touch nearly every aspect of the US economy. While lower rates can stimulate growth, increase consumer demand, and boost asset values, it's essential to understand the nuances across sectors and the potential risks involved. From the housing market to Wall Street and various industries, each area has its unique dynamics and potential vulnerabilities. As we navigate this ever-evolving economic landscape, stay tuned for more insights from EconSphere, where we keep bringing America's economy into focus. Thanks for joining us today. See you next time.